move over to the jobs market, James. I mean, we had those shock figures a couple of weeks ago, or was it last week? I forget. Time moves pretty quickly at the moment. With payrolls, big downward revisions. So May and June down 258,000. Neither month basically saw any net job creation, pretty much. I mean, what do you make of those figures?
Yeah, it's not good. Certainly the narrative has been from the Fed that the jobs market and the economy itself has been pretty solid this year. Those latest numbers really cast some serious doubt on that. Now, there was obviously a lot of criticism of the scale of the revisions, particularly from the presidents, and of course the resulting action in firing the head of the Bureau for Labour Statistics who collated them. But the problem is, of course, that there is just a lack of responses to data, and that's a data quality issue right across the board. It's not just in this report, it's in all of the data points right now. Since the pandemic, the number of responses to these input requests from these statistical agencies has declined markedly. And at the same time, they're under cost pressure themselves, and they have indeed suffered job losses, and that means that there's just fewer people to chase. So there are certainly data quality issues. That said, these later revisions bring the official jobs numbers much more into line with what third-party surveys have suggested. So, for example, the ISM, Institute for Supply Management, their employment surveys of both the service sector and the manufacturing sector have been much, much weaker than the official data. These revisions bring those much closer together. And of course, also, other business surveys as well have pointed to weaker hiring growth. Now, we're not necessarily seeing firings right now. It's more about the weakening of the hiring. And I think I would argue that in a weak growth environment, there is still that risk of hirings. And this more benign inflation backdrop, coupled with clear slowing in hiring, does offer the Federal Reserve the excuse or the justification for actually starting to cut interest rates from September.
Porrick, I mean, the September cut is sort of fully priced at this point, or is sort of reasonably in that direction. I mean, we still have another inflation report to go. We still have another jobs report to go. Realistically, is there anything that could shake the market's conviction in that rate cut story, do you think?
Yeah, this marketplace, James, has been gunning for a rate cut process for the past few quarters, to be honest. There's only two things that the market has to and throw on. One is the timing of the first cut. Is it September? Is it later on in 2025? And the second was, where do we end up? And that's varied between 3 to 3.5%. So there's been this really consistent market discount. If you look at a forward profile for the Fed funds rate, I like to use the 1 month SOBR rate. What you find is that over the next year, we have 125 basis points of rate cuts. We bottom at 3%, which, by the way, is amazing because that's neutral for the Fed funds rate. That means that there isn't huge angst in the US economy. Then if you push the forward profile further into the future, and the Fed funds rate has liftoff again. And that picture, that V-shaped picture that I have in my mind, that's been there pretty consistently over the past few quarters. So you have to have something quite extraordinary to shift that. This marketplace is expecting rate cuts, and I'd say, James, the first one, September is what we go for the most.